What's up, guys? Welcome to the market update. This is Shane Schofield, and today's date is 18th of the 6th, 2017. Quick disclaimer for you guys to read. Just have limited risk at all times and always protect yourself. Just pause that and give it a quick read. A bit about myself. I'm Shane Schofield. I'm the founder of ScofieldTrading. I trade US equities. I'm a technical trend trader, public speaker, manage a private fund. Started off spread betting from home with little or no experience, no college degrees or university degrees. Turned a 4-figure account into 6 figures in the space of 18 months, and there's an ebook available on our website at ScofieldTrading.com where you can see the whole story and also see audited accounts.
Hey guys, my name is Ty Vinnick. I am one of the co-founders of the Ace of Swords fund. So I specialize in trading options on futures, market indices, different commodities. I have a lot of experience with professional type of money market strategies, money-making strategies. I'm a market timer, so I more attempt to try to time the tops and bottoms of the market and get those swing points rather than a trend trader, and I'm also a technical and statistical trader.
Okay, guys, make sure you subscribe to our videos, and we'll be giving you frequent updates of the markets and other interesting information. Okay guys, so looking back from our update last week, we've seen that the Dow Jones has been making new highs. It's been the stronger of the three out of the S&P 500 and the NASDAQ. And as you can see where I put that horizontal line from the breakout and retest, it broke out, retest, and started pushing up again to make new highs on the Dow. At this current level, for everyone who got into this trade, I would say that the best thing to do from here is to have a stop loss if you're spread betting, and the stop loss would be underneath this bar. So just a stop loss at around 21,200 and I think 70 is the best place to have a stop loss. The reason why is because even though the market does kind of look neutral to bullish to me, we're still in the period of the weaker months of the market. And looking back on the Dow Jones, like I've said before in a previous update, is that the price action is way too far from this 200 moving average. And sure, that means that the price action could just fall straight down to this moving average, or it could actually just go sideways to rangey for a while for this 200 moving average to catch up. I still think potentially in the medium term we're going to have some sort of correction. And I can see that correction being around 10%, which will take it down to around the 19,000 level. So I think in the long term what could potentially happen, and I will always be looking at the charts to tell me the story of what's going on at the time, but looking at it from now, I think that we're going to have some sort of correction from probably July onwards. So July, August, September, we'll have a correction where the price action is going to fall probably below this 200 moving average, kind of find some sort of bottom, hang around for a while, and then confirm whether we're going to start pushing back up again to reach new highs potentially for the end of the year. So the way that I'm looking to trade this at the moment is to literally probably not even trade it at all. So I would prefer to just wait for this falling knife to happen and then wait for the right buying opportunity to take this back onto the upside. If I do try and catch this downward move, the best way I would do that is by having option puts and having expiration on them. I'll be buying them at around the money, and I'll be having expiration at least for September. So, and I'll just literally just sit and wait on it and have very, very limited risk, because I can risk a very small amount and still have, if I do catch the move, that small amount will turn into big amounts. You know, if the Dow's falling 2,000 points in the space of 1 week or 2 weeks, which has easily happened. And people need to understand that even when the Dow falls 1 or 2%, it's not going to be that much. So a 10% cutback is not going to be as exaggerated as the market's going to make it out to be. So you'll see on the news, you know, the Dow falls 600, 700 points, but really it's just a small percentage drop, and it's not that much of a big deal. So they'll scare you out of thinking that the market could potentially go back upwards, and it's not going to be that much of a dramatic drop. So that's just my total view on this trade at the moment. And yeah, if this level's broken underneath this previous bar, then I'd look to come out of my trade at a profit. And if it keeps on riding up and pushing up to making new highs, then I'll keep riding it up and keep trailing my stop loss until I'm stopped out of that at a profit. One thing that I do like, I'm a big fan of seasonality, and looking at gold seasonality, you can see that we're coming up to the best 3 months for gold. So it's from 1975 to 2016, gold has generally done good for the months of July, August, and September. So I will be personally looking for good buying opportunities in gold, which Ty's going to go over because he specializes in it. And
so what's funny is this year it's been very strong even in the weak months. So what do you think can happen in the strong seasonality month? I think we can see a very serious uptick in gold prices.
Yeah, true. So, you know, we probably could be coming up to a potential good buying opportunity at the moment, which is quite interesting. So, yeah, we'll have a look and see what happens. But I still think that the Dow's looking neutral to bullish at the moment. Mm-hmm. There's not as much. There's not as much people that are actually short. So I think about 80-something% was short, and now it's come down to 76. There's still a lot of people that are short. But it's just not. I
feel like in this IG market, people are short most of the time, right? So it's more, the game more consists of evaluating how short they are versus the. Do you ever get to a net bullish position? I've yet to see that.
It does actually reverse. When it gets really, really high, a lot of people do eventually turn bullish, and you can see bullish at around 75%. So it does actually change around. It's really interesting.
Because I follow sentiment using the options. So I look how many people are purchasing puts against calls. Mm-hmm. And, you know, that's giving a little bit of a mixed signal at the moment. So I do tend to agree with you. I think we're going to probably try another high this week, chop around a little bit, and then probably turn down towards the end of the week and start the correction. Then that would be my best guess.
Mm-hmm. The worrying concern for me is the 200 moving average, because you can go back and you see that price action always interacts with the 200 moving average at some point. It's like it kind of has to, and we've just gone so far up from the moving average that it kind of has to report back to it at some point. And I don't know how it's going to report back to it, whether it's going to be sideways or a big downward move. I know at some point before the end of the year, definitely that it's probably going to see that moving average again.
So a long position here would probably be very high risk and very low reward. So new longs are probably not encouraged at the moment.
Potentially, yeah.
Okay, yeah, and we're also saying that the Dow is doing its thing and breaking higher, but the other major three are not really doing that at all. And it's a much larger market. It has, more stocks, and it's a better representation of the economy. So, the Dow could be misleading. So we broke through this range, and now, we're either rounding it off or things like that. So to me, if we break back below 2,400 on the S&P, that will be a very bearish sign, and the correction is likely to start. But if you flip over to, and look, we had a negative MACD cross just happening as well.
Oh yeah.
So that's another sign of caution. If you go to the Nasdaq really has become from the leader of the market to the lagger, and that's a pretty bearish sign when the stocks that led the market are now starting to fall behind. Does this look like a potential head and shoulders stop to you?
It can do potentially, but I'm a big believer that there's this technology boom at the moment, because technology is just so amazing. So for me, it could potentially look weak in the shorter term, but I think technology is going to be very strong, definitely, in the medium to long term.
In the medium to long term, but we can still see a pullback to the 4,800 level, I believe, fairly easily.
Yeah, yeah.
So find support at that breakout point, and even though it's been very strong, this could, in just a matter of a couple of weeks, potentially take out all the gains of 2017. It will probably just set up the next buying opportunity for now, but it's probably not the best time to be buying into it right now. This is, to me, a very risky development, right?
Do you think it's broken that trend line, or is it bouncing off that trend line at the moment?
So I think it's up to interpretation. So exactly, it's unknown. We can still potentially turn back up for a little bit, but That's sort of the neckline here. I could see a potential dance around this level, which would be under the trend line for a few days to maybe a couple of weeks.
Mm-hmm.
A break of that 5,600 level would set up a much bigger decline, probably towards that 200-day as well. So that's also confirming what you're seeing in the Dow, but that's far weaker. And even though I'm a believer in technology as well, I think it's become a crowded trade, and many people have positions in it. So I think we need a bigger pullback to shake out a lot of people, which will set up the next buying opportunity. So we could easily see a 15 to 20% drop in the NASDAQ, especially if the Dow falls 10%.
Mm-hmm. Yeah, definitely.
So be on the alert here, because this may not break out immediately. It may take a little bit of time, but the short-term moving averages have crossed bearish already as well. So the short-term trend here is becoming bearish. Let's switch to the IWM. So this has also been struggling much more, and we're setting up a potential double top here too. I want to see it break through these levels, but the IWM hasn't done anything this year at all. So it's funny that the broadest market has actually not done a lot, which leads me to the next point. The breadth of the market, which means the amount of stocks that are participating in the rally, is consistently falling. So it means that the market has been going up, like the Dow, only 30 stocks, on fewer and fewer stocks every day that it's been rallying, almost for the entire year. So another thing to bring about with the what we talked about and how fewer and fewer stocks are participating. This is an interesting tool that I like, and here you see it in the candle bars. This is essentially the percentage of stocks. I'm looking at the percentage of stocks here that are above their 200-day moving average. Just like you can look at whether or not the Dow itself, here the Dow is in white. The candle bars represent the percentage of stocks in the market right now, not the Dow itself, but the entire stock market, that are above their 200-day moving average. You're seeing a very interesting trend in all of 2017, essentially, where the Dow keeps going higher, but the percentage of stocks in the stock market that are above their 200-day moving average has been falling significantly. This, to me, is a huge red flag of a coming correction, because back in September of last year, about 75% of the stock market was trending above its 200-day moving average. We've only fallen to 57% now. How is it possible where the Dow is far above its 200-day moving average, but only 57% of stocks are above their 200-day moving average? So that means that over 40% of, not for 40% of the stock, but almost 30-some% of the stocks right now, and more. No, it's over 40. What am I talking about? Over 42% of the stocks, or what have you, are essentially trading below their 200-day moving average and in a downtrend at the moment. So this, to me, is a huge red flag. You can see how this moves along with the market, confirming what the Dow is doing almost tick for tick. This move here was very bullish, because in early 2016, the amount of stocks that were above their 200-day moving average was only 12%. In a matter of a few months, it shot much further than the Dow, and then the Dow caught up, and I think we're seeing the reverse effect of this. This, in my experience, something like this has been an event that took place before any major correction. This red flag has almost always been there, because when the market starts making new highs and fewer stocks are actually participating in those new highs, it usually led to some sort of correction. So let's go here. And last week we spoke about the U.S. macro data. This is the running total of the jobs number, of CPI data, of PMI, which is producer manufacturing index, and things of that sort, showing the strength of the economy. We've actually had the biggest drop in macro data, and it accelerated sharply this week, since 2011, the credit downgrade. Last time this happened, the market fell almost 20%. So for whatever reason, I'm not sure what it is, the market is completely ignoring bad data. So that's why it's so important to follow the charts for a sign of when to sell, and not specifically these type of macro data fundamentals. But they are telling you that we should expect a correction very soon. Shane spoke about gold seasonality. I want to speak about VIX seasonality. This is the annual seasonality for the VIX index, which has a negative correlation to the S&P 500. This time frame usually is the most bullish time of year, and also this time frame is the most bullish time of year for stocks. Look what happens from the end of June till the end of October. This is the best time to own VIX, to own bearish bets on the market, and essentially this is telling us that volatility is going to increase significantly over the next 4 months. So what I would be looking for to trigger this, so we see this hammer bar here from last Friday's action from short-term support. It's probably going to bounce and try a new high and potentially fail towards the end of the week. And I believe if it's doing some kind of corrective move, it could look like this. And I'm just speculating here following the seasonal pattern. But I expect that this correction, at a very minimum, will see this gap getting filled. This gap here has never gone filled. Most gaps get filled. We know that. And there's a high probability that during the high VIX seasonality period, which is between July and October, so we got some time to go in here, we're going to be able to get something like this and fill this up. So I completely agree with you, and it's funny that we've been in disagreement for the last couple of weeks and we've both made money because the instruments we traded have both moved in opposite directions, right? I think that's what is showing you that the market is making these divergences with the 200-day moving average on over 40% of the stocks actually being above them, and the Dow itself being so far above its own 200-day moving average. So I find that to be a huge red flag into what potentially can happen to the market. And as a percentage-wise, we can easily be looking at that 15% drop here. Yeah. It won't even be a shocker to me at all. Now let's go back to gold. We spoke about this often. These lines are actually from last week. I didn't change them at all. So last week gold was here and we said, well, it's probably going to pull back towards this open gap area, find support somewhere around here and turn back up, right? So that's pretty spot on. What I like about this is that we're coming into a trend line. We're coming into an open gap. And see, we had a short-term trend that broke out for about a couple of days, came back off. It may continue the breakout and start moving towards those highs on this next test. We could grind a little bit lower here, but I expect that to turn. So that will probably follow that bullish seasonality for gold. It also supports the idea of a corrective move in stocks. Go to TLT.
Oh, wait, trading this for now. Could you go back to that gold chart? Would you say it's a good opportunity to get in now, or would you potentially wait for that gap to be filled first before you get in?
I would probably ladder it out because it doesn't have to. It can just come down to here and then turn back up. So what I would do is I would put a stop loss below this swing low, right around here. I would probably get into half of the position here, and I would add another half if it falls here. And I'm only risking here in this case a couple of dollars, and I'm really targeting these highs now because I think the level of the uptrend is going to significantly increase to the upside. So we're risking $2 to potentially make over 10 in this case. The miners too are starting to look pretty good. Let's get rid of this stuff. So gold miners have done fairly weak recently relative to the gold price itself. And I think they're coming up to support as well. And they've been in this long-term sort of consolidation pattern because they've done so well in 2016. So they spent almost the entire year just consolidating these gains. I think if we find support here and break through this trend line, we can see a very, very strong uptrend in gold miners. So the GDX can go up 30% in this time frame easily. And those are also counter-cyclical, so they usually move up when the markets go down as well. So you don't necessarily have to short the market. You can use one of these gold or bonds as an instrument to trade the downside. TLT we spoke about last week as well. We said it looks very bullish. It's broken out, retested, gap back up, and look at it now. It's not even giving up any gains at all. It's just holding this gap for now. So we're coming up to some big resistance here, and I believe a very strong test is going to take place. We have a large open gap here that is probably going to get filled in some way, partially or not partially. If we can get over this level and above 130, I think we're going to make new highs in this as well. So this is a bearish development for stocks as well. The bond market is very strong, and it's telling us that the economy is slowing down. When bonds are strong, that means that interest rates are falling, which means the demand for money is falling. If the demand for money is falling, that means the economy is weak. Well, guess what? That fits this very well. Bonds are essentially following the macro data that is deteriorating and showing that the economy is deteriorating. And for now, stocks are ignoring it. We're seeing it in many markets. We're seeing it in gold. We're seeing it in TLT. We're coming up to bearish seasonality, and the divergence in the breadth of the market is becoming pretty significant. So yeah, I think we're very, very close to making a substantial move to the downside. And I'll be trading it in multiple ways. I'll be trading it primarily via options as well, but I'm doing spreads on the options to pay for my bearish bets essentially. So I won't go into too much detail about how I'm going to do it, but I'm going to have some very interesting plays on this coming correction.
And why do you think that is with TLT going up, with interest rates going up? Because obviously you had the Fed meeting on Wednesday, and they've announced that they're raising interest. They raised interest rates. Why do you think that is? The TLT still goes up.
So that's exactly the opposite reaction of what you would expect, right? This big move up was actually on Fed Day when they raised rates. So you're telling me what? They raised rates and rates went lower? Well, that's exactly what happened. And I think the bond market is smarter than the Fed. That's what I think. And the Fed is making a big policy error, hiking rates into a deteriorating economy. So the macro data is getting worse, and the Fed is still raising rates. So I think the bond market knows already that they're not going to be able to continue to raise rates. And the bond market, or any market, is forward-looking. They're looking 6 months into the future, not what happened today and yesterday. They're looking at what's going to happen 6 months from now. And I think the bond market is telling us that the Fed is making a mistake, and they're not going to be able to raise rates anymore this year. This rate hike in June may have well been the last one of the year, even though they said they're going to do it one or two more times. I don't think they're going to be able to. I think the stock market's going to fall 15 to 20%. And I think the bottom of the stock market is probably going to be when the Fed actually says, hey, we're not going to raise rates again. Mm-hmm. So we should be looking at the September meeting as a potential bottom for stocks, because that's what happened in the prior year and the year before, where the Fed said, hey, we're going to raise rates, and they couldn't because the market fell. Mm-hmm. So I think the bond market's already telling you what's going to happen. It's telling you, well, the Fed's not going to be able to raise rates more. The bonds are going to continue to go up. And when the Fed stops raising rates here, it's all going to be priced in, and it's probably going to be the time to sell bonds. The first time the Fed raised rates for the year was the bottom. The Fed raised rates here, bonds go up. Fed raised rates here, bonds go up. Fed raises rates here, and it's going up from much higher low after a breakout. So the bond market's telling you, hey, the economy is not as good as what stocks think it is. Mm-hmm. And from what I found, when stocks and bonds disagree, it's usually bonds that end up being right, because the smart money, the Wall Street money, usually trades bonds, and the hot money, momentum money, and retails usually trade stocks. Yeah. So the bonds tend to know what's going to happen a few months before stocks do. So before every big correction, I've seen two things. The first thing I saw was bonds have bottomed and started moving up ahead of a top in the stock market. Mm-hmm. And the second thing I've seen was this, sorry, I'll go here. The second thing I've seen was the 200-day percentage above stocks above 200-day moving average started falling in this manner. So we've seen these two. If you remember the big correction in 2015, May, June, the market peaked in May, but percentage of stocks above 200-day moving average was peaking months in advance.
So that was a pre-warning before the actual correction happened.
That was a pre-warning before the actual correction happens. And it works both ways. You know what? I'm going to actually go through that for a second. Let's compare this to the Dow for fun. And here it is. Look at this huge deterioration while the Dow is not. The Dow actually made a higher high, and this already started falling. So you ended up being right and you ended up being wrong?
Yeah.
Also an interesting fact is that this made a low here. The Dow made equal lows. This made a higher low. That was a bullish signal.
Okay. That was a sign of a reversal.
That's sign of reversal because even though the market has been very weak, the percentage of stocks above their 200-day average have improved dramatically. In the January bottom, it was only 9% was above the 200-day moving average. And in the second bottom came 2 months after, already 12% were above their 200-day moving average. And look and behold, the whole market rebounds after. So what I'm seeing here looks to me very similar to what we saw in the summer of 2015. So the warning signs are there. The question is how we make money off of it, right?
Yeah, that's always the question. But it's very interesting, though, that 200-day moving average to companies that are below the 200-day.
Because at the end of the day, the market is made out of the stocks that are making it, right? So we have to watch and see if the stocks themselves are confirming it, or is the market going up on fewer and fewer stocks. Eventually, those fewer and fewer stocks are going to turn down as well, because this is a sign that liquidity in the market is drying up. There's less money to chase those stocks higher.
And it is quite worrying that the fact that the Dow is so high above its 200, and there's a lot more companies that are below its 200.
Over 40%. It's pretty crazy.
Yeah, that's incredible. Okay, guys, so coming soon, we've got our options course that me and Ty are currently working hard on. And basically, it's going to teach you all the basics of options trading. And you're going to get to learn the secrets of, hedge fund managers with different option strategies. And it's going to be, very a lot of information to teach you exactly what we know and how we trade the markets.
So I think we're going to come up with something that's unintimidating for people with very limited or no options trading experience at all. Going to teach them how to create an account, trade options, look at option quotes, look at option chains, how to make money in all different type of market condition, and most importantly, how to limit risks. For example, if you want to trade the upcoming correction, you would know how to do it really well, risking no more than 1 or 2% of your portfolio and potentially making many multiples of whatever it is you're putting in this specific trade. And I think we're going to put it at a pretty competitive price point to what's out there in the market as well, just to make it accessible for as many of you guys as possible.
Yeah, most definitely. So we look forward to bringing you that very soon.
Okay, so I'll see you next week.
Yep.